Warren Buffett calls cash oxygen for businesses, critical in a crisis. Companies with strong cash positions have strategic flexibility that debt-laden competitors lack. They can acquire assets cheaply during downturns, invest in R&D through recessions, and return capital to shareholders without financial stress. Today, we're analyzing 28 companies holding a combined $400 billion in cash and equivalents, the Fortress Balance Sheet Club. Quick definition, we're talking about cash and cash equivalents, liquid assets a company can deploy immediately. Not revenue, not market cap, not assets that take time to sell. This is money in the bank ready to be used strategically. The numbers range from CrowdStrike's $4.3 billion to Alphabet's $73 billion. Let's break it down by tier. Tier 1, the cash giants, $60 billion plus. Alphabet leads with $73 billion. NVIDIA follows with $70 billion, accumulated primarily over the past 2 years of AI chip dominance. Amazon and Microsoft tie at $62 billion each. These aren't just large numbers, they represent strategic dominance. Alphabet's cash lets them invest billions into AI research with Google DeepMind without worrying about profitability timelines. NVIDIA can build new data center infrastructure or acquire competitors. Amazon funds AWS expansion and logistics build-out. Microsoft finances OpenAI partnerships and Azure growth. These companies have the cash to pivot business models, make transformative acquisitions, or weather multi-year investments that don't immediately pay off. Tier 3, mega cap war chests, $25 to $50 billion. PDD Holdings, parent of Temu, holds $50 billion, primarily from aggressive e-commerce growth in China and global expansion. Apple at $41 billion is remarkable because they return massive capital to shareholders through dividends and buybacks, yet still maintain this fortress balance sheet. Meta's $37 billion funds metaverse investments and AI infrastructure. Alibaba's $26 billion provides strategic options in China's challenging regulatory environment. These companies have the cash to pivot business models, make transformative acquisitions, or weather multi-year investments that don't immediately pay off. Tier 3, quality players, $4 to $15 billion. These aren't the biggest absolute numbers, but they're incredibly strong relative to business size. Airbus, $15 billion for aerospace. Hermes, $14 billion for luxury goods. ASML, $10 billion for semiconductor equipment monopoly. ServiceNow, $7.4 billion. Palantir, $7.1 billion. Spotify, $7.1 billion. Then you have cybersecurity leaders, Palo Alto, $6.3 billion. CrowdStrike, $4.3 billion. Enterprise software, Salesforce, $5.2 billion, Viva, $6.6 billion. These companies combine strong cash with focused business models. They're not trying to do everything. They dominate niches with fortress balance sheets backing them. This tier represents quality over quantity, companies where cash provides defensive moats in specialized markets. Here's what cash means strategically. During market crashes, cash-rich companies buy distressed assets cheaply. Think of how tech giants acquired struggling startups in 2022-2023 at discounted valuations. During recessions, they continue investing in R&D and marketing while competitors cut back, gaining market share. For shareholders, cash enables buybacks when stock prices are low and dividends regardless of economic conditions. Cash also provides negotiating leverage. Companies with strong balance sheets get better terms from suppliers, lenders, and acquisition targets. The hidden advantage, talent. Engineers and executives prefer working for financially stable companies over those living paycheck to paycheck. Cash attracts capital, both human and financial. 28 companies, $400 billion in cash, from tech giants to luxury goods to cybersecurity specialists. Fortress balance sheets provide optionality, resilience, and competitive advantage. In uncertain markets, cash is the ultimate moat.